Good evening, everybody. My name is Shaun from Berg. I'm from PSG Online. I head up client education. Just to get started, I'd like to ask a quick question. How many of you have developed a trading strategy before? Great. Thanks a lot. Okay, looks like most of you have not developed a trading strategy. So here's my agenda. The idea is just to quickly discuss what is a trader. And like my past webinars before, I think a lot of people get confused between a trader and an investor. Obviously, the main focus tonight is talking about a trader, but what is a trader? And obviously from that, we're going to talk about what is your risk profile, your trading style, and then touch on a trading plan. But the main presentation tonight is working on what I call a high probability trade. And there's various strategies out there. The one I've been using for years is called Breakout trading. Using chart patterns, and we discussed 3 of those chart patterns and the ideas of the steps behind that. So the idea and the main objective of tonight's webinar is just to highlight for you guys that it's developing a trading strategy. And as you become more knowledgeable about trading and more knowledgeable about technical analysis, you find what works for you, and you stick with that. And I can give a word of advice I've learned over the years is to keep it simple. And the more complicated, and then that you're not going to make money from that. It's keep it simple, and that's how you make money. Okay, so let's move on. So, as a trader, trading can be both profitable and gratifying. It's nice, especially I know a lot of us aspire to be sitting at home and working from home, especially trading the markets. And I know some of you on this webinar do that, and I've done it in the past myself. But to maximize your financial profits or the benefits of being a trader, and also your enjoyment. I believe if it's not enjoyable, don't do it. You need to decide what kind of stock trader you are. So we'll talk about it again just now, the different styles, and I know I've harped on this in the past, but it always depends on a lot of things. And number one, your personality. Now, if you're a conservative person and you want to be a cowboy as a trader, you're going to have a bit of conflict there. You're not going to be able to sleep easy at night. But as a trader, compared to investing, you need much more time. And we'll talk about different styles just now and how much time you need. But that's very important. The more time you've got, the better your chances are of being a trader. And when it comes to capital, the money we involved, I always talk about risk capital, because obviously this is money you can't afford to risk. The more, the better. And obviously, lastly, is your risk profile. As a trader, you want to take on higher risk, hence the higher or the potential higher returns. Okay. So I use this as a roadmap. I call it my roadmap. We talk about your financial objectives. And obviously, in this context, we're talking about as a trader. Now, my goal every month as a trader would be to make between 10 and 15% on my margin. Okay. And if you multiply or analyze that, you're doing pretty well as a trader. So that's where I start. And we'll talk about a trading plan just now, how you work this thing backwards. So that's my goal as a trader, 10 to 15% per month. That might be conservative. Some of you might be doing much more than that. I'm happy making those kind of returns. When it comes to risk capital, as I said just now, the more the better. I find the more funds you got, the more flexibility you've got. And also when it comes to risk management, especially on what they call money management, we talk about position sizing. The more funds you got, the easier it becomes also. So the most important resource, instead of money, I believe the most important resource as a trader is time. So you need at least half an hour a day as a swing trader, placing the trades, maybe at night, and then obviously following up intraday and things like that. But I've learned over the years that, we come back to it, I say the trading plan, you do your homework at night, you review it in the morning. That all takes time. So it's much more than just placing the trade and much more than just researching it and things like that. All those other logistic things you have to take in consideration. Your level of knowledge and experience is also important. So we talk about, obviously as a trader, you need to have a good knowledge of technical analysis. Getting your timing right is a critical success factor. And this comes with, we talk about trading experience. Start small. And maybe you might do some paper trading, you might want to simulate. But the main idea with this is to gain confidence. Confidence in your stock picking abilities, and obviously confidence in your methodology or your trading strategy. And very, very important, a lot of people don't take into consideration is your risk profile. And I know I have spoken about this in previous webinars. You know, we talk about being a prudent trader. And if you look at it, the one highlighted there in red, another word for prudent is being a wise trader. So you want to go for high rewards at low risk. And we'll talk about it in a few more slides. We'll talk about high probability trades where you want to bend the odds in your favor. So that's a quadrant you want to be in. You want to go for high rewards at low risk. Some of you might be more on the aggressive side. I call those the cowboys. High reward at high risk, it's fine, provided you're looking after your risk management. You're watching your risk management very, very closely. You should never be in that last quarter at the bottom there. We talk about being speculative. This is the gamblers. I believe you should never be in a situation where you're going for high risk but at low reward. You're wasting your time. You're throwing your money away. Okay. So you want to be in the top left quadrant there as a prudent investor. High risk, high reward at low risk. Okay. So from that, those kind of questions you ask yourself, you'll ask yourself, okay, what kind of trader am I? We talk about a position trader. You can be a swing trader or a day trader. These are three broad styles of being of trading. And we'll go into each one of them into more detail now. A position trader, I call this the active investor. Instead of buying and holding, remember as a trader you're buying and selling, but you're holding a position more for the longer term, from a few months to a few years. You might even say from a few weeks to a few months to a few years. So you're not concerned about the short-term fluctuations. That's what a swing trader or day trader will take advantage of. You're looking at more the longer-term view, and you'll believe that your long-term investment horizon will smooth out the short-term fluctuations. Okay, so you use more the weekly and monthly charts, and your goal is to establish what is the primary trend. Are we in a bull market or bear market? And also from there to try and trade what we call the secondary cycles. Are we trading a correction, or are we trading a rally? So we're ignoring the day-to-day fluctuations. Okay, so that's a position trader. Some of you might be doing that. I do that myself, especially on the CFD side, because there's no expiry. So I like to use that for more of the position trading. Most of you will be what we call a swing trader. This is where, and this is information I got from Investopedia's website. They say a swing trader is someone who's holding a position from 1 to 4 days. I look at anything from 2 days to 30 days as being a swing trader. So you're looking for shares of short-term price momentum. So you're ignoring the fundamentals or what we call trying to establish what is the fair value of the share. So you're looking at more the technicals. I'm looking at price trends and patterns, and we'll talk about it in a few slides time. I'm looking for shares that have the potential to move fast in a short period of time. So as a swing trader, you must be able to act quickly. You see this opportunity come along and you grab it. This is what a swing trader would do. So whereas large institutions don't have the flexibility to move in and out the market because of the sheer weight of funds they've got, you as an individual trader can exploit the short-term price movements and take advantage of that. But saying that, you're not competing with the institutions. I believe in taking advantage of where the institutions are moving the money and exploiting that move. Okay. Then some of you might be looking at becoming what they call a day trader. This is someone who wants to trade intraday. You actually close your positions out when the market closes. You hardly ever hold a position overnight. Most of the time, the guys are using leverage, like with the derivatives, single stock futures, CFDs, the index futures, that kind of stuff. You want to go for small share price movements, small percentage gains, and obviously with being in a leveraged position, you're maximizing it out there. But day trading has been glamorized and things like it in movies. But the perception out there is the easy path to riches. But that's really the case. Now here's a little warning from the Securities Exchange Commission, which is similar to our FSB, our Financial Services Board. Day traders typically suffer severe financial losses in their first few months of trading, and many never graduate to profit-making status. Now, I was reading somewhere about 70% of day traders, 70% of day traders do not make money. Now, that's a worrying factor. So it's a very small percentage. So as I said, most of you will be falling into the category what we call a swing trader, holding a position from 2 to 30 days. Okay. So let's talk about a trading plan. And this is part of developing a strategy. You need to have some guidelines or some in a context. So this is your the broad plan, and obviously on a daily basis we talk about having a game plan. So we talk about defining your trading philosophy. Are you using more technical analysis, or are you using more fundamentals? Are you using more chart patterns, or are you using more technical indicators, that kind of stuff? So you need to document this, number one, and number two, the more detailed, the better. Okay. Also, a very important part of the trading plan is obviously your risk control. And I always refer to Dr. Alexander Elder's book, Coming to My Trading Room. He talks about the 3 M's. So the 3 M's stand for methodology, trading method. We'll talk about it tonight. He talks about money management. And money management is broken down into what we call risk management. That's using a stop loss. And then also the other side of the coin in money management is the position sizing. Okay. So you need to document this and be specific. What happens in certain cases? What happens if the market goes against you? What are you going to do? Okay. And I mentioned just now having a planning time, a routine. You know, the market closes at 5 o'clock. The futures market, or the index side, runs off until 5:30. Most of the time you can download your share packages. You have at 8 o'clock at night. But the idea is to have a routine. Go through the today's trades. How does you fare? Did any of these trades get stopped out, or which ones of them you still hold? Have any of them come to near your trade, your take profit, that kind of stuff? So you review that, and then you say, okay, what's going to change? What must happen to change? And then the next morning you do the same thing again. Look at what's happening in the States, what's happening with Dow Jones, and anticipate what's going to happen on our markets, how our markets are going to open. That's all part of the time routine. I found it useful to maintain what I call a trader's diary. I use an Excel spreadsheet, and I document every single trade I put on. So I'll have my entry price, my exit price, my stop price, and those kind of things. What is the margin required, and work out all these kind of things, and I keep a documented history of that. I go one step further. I actually keep what I call a notebook. And I write down how was I feeling. So I'm trying to establish for myself what is working, what's not working. So did I make the trade more on fundamentals? Did I make more trade on technicals? Was it a tip? Was it just a thumbsuck? Did I go on the impulse? Those kind of things. So I can start seeing a bit of a history, a bit of a trend, and I can start focusing on it. Do I make more? Am I more profitable going long? Am I more profitable going short? Those kind of things. So that's where I talk about analyzing your personal trading. How can I improve? So I always believe in using like a funnel approach. When you make mistakes in the beginning, make a lot of mistakes, but learn from the mistakes. And as you learn more about the market, make less and less mistakes. So that's all part of your trading plan. Okay, so obviously it's a working document. It's a work in progress. I find it very, very useful to document it. And some people talk about a trader's journal. I've got a lot of books talking about that, and that's very, very useful. So yeah, I want to talk about tonight is using a facility, talk about breakout trading. Now, I mentioned just now about what I call high probability trade. The common theme here with most novice investors, and I mentioned just now with the SEC story, within 6 months of launching your career as a trader, most people are out of their money or out of trading. Okay, so bottom line, trading is all about probabilities. Okay. The most important thing you can learn as a trader is become disciplined. You know, the biggest enemy in the share market is human emotion. On one side of the scale, you got fear. On the other side of the scale is you got greed. You want to position yourself right in the middle and be objective. And the only way to be objective is to use discipline. Do what you're supposed to do when you're supposed to do it. So that's the first thing you need to start learning. In terms of time, is be disciplined in your approach, number one. And number two, very, very important, is be patient. The strategy I'm going to talk about just now, you need a lot of patience. So that's the one side. Another side is following very close onto discipline. You need a working knowledge of the type of trading, the theory that you're doing. So obviously the style of trading, number one, the strategy you're using, you need to have a working knowledge. What is the theory behind it? But the main idea, or the main reason for doing high probability trading is the psychology. I'm the kind of person, I hate losing money on the market. Yes, it's part of the game. Okay, you pay school fees, but I don't like to lose money unnecessary. So the whole idea about high probability trades, and I use the phrase where you want to bend the odds in your favor. So, you know, I want to be in a situation where I don't lose money. So if the reward outweighs the risk, then go for it. In other words, you only enter a trade when it's very close to a sure thing. Gee, the chances of you losing money is very, very negligible. So it comes back to what I talked about just now, having that trader's diary. You start working out your success ratio and things like that. We spoke in the past, I have spoken on this forum regarding a risk-reward scenario. I'm only willing to risk 1 rand to make 2 rand. Ideally, you want to risk 1 rand to make 3 rand. Okay, but when it comes to your trades, I believe in being successful 2 out of 3 times. That's the minimum benchmark. In other words, a 67% success rate. For every 3 trades I put on, 2 of them are going to be winners. Some of you might be more conservative. You say, gee, 4 out of my 5 trades. In other words, I want to go for a higher success rate. But yeah, I still have to meet someone that does that consistently. I'm happy with my 70% success rate. Okay, that comes with time. So if I look at 70% success rate, out of every 10 trades I put on, I know 3 of them will be losers. But I manage those losses very, very tightly. They're very, very small. Okay, so that's why we talk about high probability trading. Okay, so let's talk about this strategy. This is a strategy, very simple. Anybody can do it. It works in all time frames. You can do it for day trading, swing trading, or position trading. It's ideally situated, ideal for a swing trader. What it is, you're taking a position within a trend's early stages. When we talk about a breakout just now, you'll see we used various chart patterns. So you want to take up a position. And when I say take up a position early, it's recognizing the pattern as it's starting to form. So a breakout occurs when it moves outside a support and resistance level. Now I'm assuming some of this terminology you guys learn, already. A support level is a floor, a resistance is a ceiling. So I'm presuming that you guys know about some of that already. I refer you to some of our online webinars or online tutorials. You can learn more about technical analysis. Now we're talking about price action, but also looking at volume, people's commitment to price. So I want to see increased volume. I want to see people's commitment to a breakout. I want to see volume increasing, and as there's panic buying or panic selling. That gives me the psychology aspect to it. Okay, so when it comes to support and resistance, especially using trend lines, the more times the share price has touched the support or resistance level, the more reliable that area is, the more valid it is, and also the more important the breakout will become. Okay, so the longer the support and resistance level has been in play, the better the outcome. Okay, so that even gives you that high probability, the more reliable that pattern is. And there's 3 patterns on our highlights. First of all, we talk about a sideways market. This is what they call range trading. Remember, there's 2 kinds of markets always. You always need to establish that for yourself. First question you ask yourself, what kind of market are we in? Are we in a trending market or are we in a trading market? Okay, a trending market, the trend is definitely up or definitely down. That's a trend. A third of the time, the market's moving sideways. It's what we call consolidation. I call that range trading. It's when the market's moving between an area of resistance and an area of support. Okay, as in highlighted. Let me just get my cursor again quickly here. There we go. So there's the area of resistance. It's usually a round number, and there's my area of support. Okay, so we're moving sideways within this range. And eventually we're waiting for new, because remember, we've got buyers and sellers having a bit of a tug of war. We're waiting for new information. The information is positive. We break out of this the sideways market, and that's where we get into the trade. Okay. Now, it does sometimes pull back, is what we call breakout, break and kiss. So it breaks out and comes back and kisses previous resistance. So previous resistance will become the new support level. Okay, so you must anticipate this. This does happen. Okay, so it comes back and kisses it, and then it'll bounce off. If it doesn't, it breaks through this, and then obviously that's where your chart pattern fails or your trade is off. So some people like to put a stop just below this. I like to put a stop way down here. Okay. So you need to be able to handle those drawdowns. Okay, so this is where you'll go long on a breakout, on a bullish trend. If you want to go short, here's a sideways market. We're hitting a support level. Eventually that support doesn't hold and it breaks out through that on increased volumes. That will be your confirmation. Okay, that's where you'd go short. Now again, some people will put their stop just slightly above it. Depends how conservative you want to be. I might go as far as way up top here. Okay. But I'll be watching it very, very closely. Again, it breaks out and comes back and kisses it before it says goodbye. Okay, so this is one of the most popular patterns I like to look for. I try and scan for these kind of patterns, and I explained just now how I do it, and then I wait for this little pattern to form, and I wait for the breakout. So this is what I call a rectangle formation. It's a continuation pattern. Remember, this can also be a bit of a complex triple top. You can move from the bottom, move to the top, and eventually bounce up and then break down. It always is a complex triple top. So you need to act only on the breakout. So there's some confirmation rules. Some people like to wait for a 2 or 3% increase before acting on it. So I look, my criteria must close above the previous resistance level. Okay, yes, I'm using a line chart. You might need to use a bar chart or candlestick chart. And also the candlestick chart pattern also give me an indication what's happening. Okay, let's move forward on to the next one. The other pattern I like to use often, and this is my favorite, is triangles. This is a symmetrical triangle. Again, it's a consolidation, moving sideways. Remember, it's a continuation pattern, so it comes from the bottom. Let's put my cursor again. What's nice about this pattern, I know where it's going, and also know I know the trend, and also know where it's going. So it's coming from the bottom, moves sideways through a little triangle pattern, and breaks out. But it continues on its original path. Okay, so that's what's nice about it. So I know where it's going. I know the trend is up. Most of us get the trend wrong, in the sense that we're on the wrong side of the market. We think it's a rally or a correction, and we're on the wrong side of the market. What's nice about it is also a triangle is you can actually measure the height, and from the breakout you can project it where it's going. So let's say that was 10 Rand and that's 15 Rand, so you've got a 5 Rand spread there. You're going to add 5 Rand on the breakout from there, and we're going up to 15 Rand. Okay, so you know where the trend is, where the market's going, and you've got an idea with regarding price projection. Okay, very, very high probability indicator. Remember, you want to confirm, you want to see higher volumes on the breakout here. Okay, some rules also, I must touch at least 3 times, and ideally break out at least 2/3 of the triangle. Sometimes it breaks out right here, and then you'll see some examples just now. The idea is just to get the idea across to you guys. Okay, that where it's breaking out near the apex. So those are 2 continuation patterns. Some of you might use what they call reversal chart patterns, and the most famous one is what they call head and shoulders. What I like about this one is that, again, you can use it as for anticipating or projecting where the market will be going. So here's your left shoulder. Let me just draw my little cursor in again, my spotlight. There's my left shoulder, comes back. My next rally is higher than the first rally, so it still tells me we're in a bullish trend. Pulls back again, bounces or bounces off a support level, rallies again, but my next high, my next resistance level is lower than the previous high. Okay, and then we break out. The idea is that we're going to draw a neckline, a trend line. We call it a neckline, connecting the 2 support levels together. And the minute it breaks out through that trend line, as the word implies, the trend is changing. That's where you'll break out. Okay, you only act on the breakout on increased volume. So I want to see some panic selling coming in. Okay, so that's at the top of the market, trend reversal down. Bottom of the market, just the inverse head and shoulders, same criteria on the breakout of that neckline. On increased volumes, I can also still project where the market's going. So you've got about an 80% probability. Let's say, for example, you've got a sell signal here at 10 Rand. You've got 80% probability of going down to, and this is a 2 Rand spread here, 2 Rand difference. You've got an 80% probability of going to 8 Rand. Would you go for it? Yes. Okay. Where would you put your stop? Some guys put a top here, some guys put a previous high. But it's always important to put your stop in place. Okay, so I know what price I'm getting in, I know where my stop is, and I know where my target price is. Okay, so the question always is, how do I find these trades? And whatever I do is on a weekly basis, usually on Sunday afternoon, the process of what I call identify, oops, let me go back, page up, identify the candidate. Obviously, I've got a watch list, and I only trade the top 100 companies, and I'm making a smaller list from that. So I'm looking for companies that have built a solid support and resistance level. So I'm looking for shares moving sideways. And one of the indicators I use is the indicator called directional index, DI. On my Wing Professional, it's called DI, but it's got 3 different indicators in it. There's one specific one I like to use. It's called ADX, Average Directional Indicator. So I use that to scan the market because it highlights either shares trading or trading. So I'm looking for shares where their ADX is pointing down, and preferably below 20. You'll see in the next graph where I highlight about that. Then I only focus on those companies and I'll wait for the breakout. That's the biggest challenge of the strategy. And as I say, You have to be patient and wait for the breakout. Okay, so you wait for the price to make the move. So I did a scan this morning. Here's the ADX. This is this little pink line is the ADX on the highlight for you guys. When it trends up like that, okay, it tells me we're going into a strong trending market. When it comes down, we're going into a sideways market. So my cursor here again. Okay, so when it trends up, pink, we're going to a trending market. When it comes down, we're going to a sideways market. Okay, so yeah, you can see we're going to a strong trending market, and we were trading, and we were below 20. So this was just, I just scanned, and it gave me a whole list of shares. I'm just showing you the example. Here's Amplat's moving between a support level, roughly about 445, and a high of about 490. Okay, it's also making a bit of a triangle. Okay, yes, it's breaking out, coming quite close to the apex, but and it's also above this 200-day moving average. So I always say we go long as long as it's trading above the 200-day moving average. So this is a very important support level. So I want to see it's going to break out from there. Okay, you can see the ADX is positive, crossed above the negative. That gave me a buy signal. So I can anticipate a breakout from here soon. Yes, it might break out from there, and my next target will only be there. It might even go higher. Okay, but remember, this is 52-week highs here, so this could be a possible trade coming up. Okay, so that's one example. Here's another one I did today. This was Rand Merchant Investment Holdings. Again, a similar triangle, but you can see your ADX came down very, very sharply. Okay, so just highlighting. As I say, my point is just to kind of get across to you to find these shares. I use a simple indicator called ADX. Find these shares that's moving sideways, and let me look for a breakout. So you can see it's a very important resistance level. It's touched about 3 times in. We get my cursor again. Okay, touched once, touched twice, 3 times. Obviously, I don't know what happened today. I didn't watch it today, but it's got a high probability of breaking out through there. You can see it's still oversold. It's got a high probability of breaking up. Again, new highs. Breaks up new highs carry making new highs. This might be a possible trade too. So this is the kind of thing you're looking for. Okay. So guys, just moving forward quickly, when I get in is, and this is all part of the plan. You always plan the trade before you put it on. You need to know what price am I getting in. Okay. So if it breaks above a resistance level, just above it, that'll be your entry level. It's if you break above resistance. If it breaks through below support, you'll have to establish a bearish position or a short position. Okay. There's a difference between a breakout and a fake out, so it's important to have some confirmation rules. As I mentioned just now, that they do break out and come back and retest. Remember, break and kiss. So old resistance will become new support, and vice versa, and old support become resistance. Okay. So know when your trade has failed. If it breaks through your support level, break through your stops, get out. Okay. So it does happen. So I'd rather lose a little bit of money than losing all my money. Okay. Also very important to set reasonable price objectives. We talk about a take profit or a TP price. So that's why I always find useful to use chart patterns, like sideways market, or again, between the support and resistance levels. I can measure that distance, 5 Rand difference. I add on to the breakout. I can measure the average move, especially shares that are quite volatile. Move up 2-3%. I can calculate from there what is the average move. Okay. What's very important also to understand is have an exit price, because you need to know where am I getting out. This is a lot of us don't have that exit price, and we're trading on hope. Hope is not a strategy. Okay. So before getting in, I always believe in knowing where am I going to get out, but also where am I going to take my profits. So you also need to know where am I going to stay in the trade and where must I get out. Okay. So guys, I hope you found this beneficial. Breakout strategy does require a lot more patience. So again, it comes back to your personality. Some of you might not be, this might not be for you. I've got a few webinars coming up next month rather, at PSG. We're talking about gap trading. Some of you might want to trade gaps as a strategy. But the main idea is that this strategy does eliminate human emotion. So it does help you become more objective, and obviously more objective about the trade. I know where I'm getting in, I know I'm getting out, and I know it's my stops. So high probability trading, as I mentioned just now, bends the odds in your favor. So it's very important to have a trading plan. I know it's a cliche, plan the trade and trade the plan. And if you do that, you will be successful. So on our website, we have a lot of other tutorials, teaches more about technical analysis and trading and things like that. So this presentation will be sent out to you guys in PDF format as well as the recording. But look out for our upcoming webinars and Traders Forum. But thanks a lot. Thanks for your support, and we'll hear from you guys again. Yeah, all the best.